Hey everyone, and in today's video I've got something very special planned for you all. Now, for those of you that have just joined the channel, you won't know this, but for those of you that have been with me for a little while, you'll know that I actually used to work a lot with my brother. In fact, we started our financial trading careers together. We set up a private investor fund together. We used to do everything together. But a few years ago, we decided to go our separate ways and kind of pursue different projects. But this year, in 2021, we've decided to join forces again. And that is actually just great news for you guys, because the things that we're working on, I know that you're going to absolutely love. And what we're doing is that we're looking at ways to bring institutional trading strategies and an institutional approach and put it in a framework that retail traders are able to utilize. And we're going to demonstrate some of that in today's video. Because in today's video, I'm going to talk about 2 trade ideas that are based on this framework. And I'm going to show you the power of this framework. And ultimately, what I'm going to talk to you about is how you can actually be right, or how you can make money in the markets, even if you get the wrong direction. Okay, so stay tuned and make sure that you stay here till the end, because you're going to want to know all of this. But before we get into it, please make sure that you are subscribed to the channel. So if you haven't already subscribed, please hit that subscribe button and then hit the bell so that you stay up to date with all of the notifications. And you're definitely going to want to do that this time, because as I said, we've got some amazing videos planned for you guys, some strategies, some frameworks that's absolutely going to change the way that you look at the markets. Okay, so with that being said, let's get into it and let's look at the trade ideas and let's look at this framework and what I'm talking about and how it's going to change your trading. Now, the first thing that I want to broach is this myth that entries are everything. Now, retail traders, they obsess over their entry points. They're convinced that if they can just find that perfect entry point, then they'll be able to make money. But in the professional trading community, there's actually a saying that it isn't where you enter, but it's where you exit. And a prime example of this is a market maker. So if you're working for a big institution as a market maker, one of your primary responsibilities, or your primary role, is to ensure that there's liquidity in the market, which means that when your clients call up and they want to take a big position in the market, you have to provide them a price. And assuming that they're willing to pay that price, you then need to take that position on. So what these market makers do, or what the position that they find themselves in, is that they have to take positions that actually they don't want to have, and then they need to trade their way out of it. Okay, so they don't get to pick their entry points. They just kind of get to pick where they're looking to exit from the market. And I can tell you this because a friend of mine does exactly that. That's his position trading for one of the big investment banks, is that he has to sit there. And yes, he does some trading for himself and things like that. But a big part of his role is actually to take positions for his customers, for his clients, and then trade his way out of it and make sure that they mitigate the risk and they mitigate, any losses that they may suffer as a result of taking positions on that actually they don't want. So that got us thinking, how can we sort of apply this to the retail market? And we believe that the best way to do that is basically to embrace the randomness of the market. So not to focus so much on where we're entering, but to have a process-driven approach that actually looks at the mid to long-term direction of the markets, and then utilize a grid trading approach to really kind of contextualize price. And what this does is this removes the timing equation from the market. So it allows us to make money in 2 of the 3 trading conditions that you're going to be in. So, if you're trading the markets, it's either going to be ranging, it's going to be trending, or it's going to be reversing. And utilizing this approach here, you can make money if the market's ranging, you can make money if the market's trending, and if the market is reversing, then you put yourself in a position where you're able to mitigate your risk somewhat. And that's what we're going to be showing you as we progress through these videos here. And the 2 trade setups that I'm about to show you are based on this framework, and it's also based on this process-driven approach, whereby we've got a number of different quality gates. So by the time you actually get to taking your trade, the long-term direction of the markets is you're really sort of unlucky if you get that wrong. But even if you did get that wrong, by utilizing this approach right here, you'll put yourself in a position where you'll still be able to make money. And at the worst case scenario, you'll be able to mitigate your risk. Okay, and I'll show you that when we get to the charts. But let's first talk about some of the trade ideas that we're looking at and the approach that we're taking for it. Now, the first trade idea is a pound-driven trade idea, and we're looking to express our view in cable. So we're going to do it in the pound dollar. Now, early in 2020, traders shifted their focus from the uncertainty over Brexit and all of that negativity over Brexit to the COVID lockdown, okay? And market analysts are actually currently forecasting that the Bank of England will increase its assets purchase program by a further 150 billion at the next meeting, which is in early February, which is actually negative for the pound. However, and importantly, the markets are poised for negative rates, okay? But we actually think that this is unlikely to happen anytime soon, making for a bit of a supportive environment for the pound. Now, one of the things that we look to kind of get our long-term view on which way a currency or a currency pair is going to go is the interest rate differentials. And the interest rate differentials between the Bank of England and the Fed are actually pretty much at zero at the moment. So what I want to show you here is this is a chart where we've got the interest rate differential, okay, between the US and the UK, and we've got the exchange rate. So the blue line is the rate differential, the orange line is the exchange rate. And look at how the interest rate differential actually leads the currency markets, okay? So if we look over here, when the interest rate started to rise up, the market then rose up with it. When the interest rate differential dropped, the markets dropped, it rose again and the market rose. And we've got this constant relationship with the interest rate differentials and the exchange rate. So then over here, when the market started to go sideways, the interest rate differential didn't move, the markets ranged and didn't really trend in any one particular direction. So this kind of shows you that really there is a close relationship between the interest rate differentials and the exchange rates. Now, whilst this isn't everything, it definitely is one of the key drivers and one of the things that we have in our framework that helps us identify which is the long-term direction for a particular currency pair. The other thing that we look at, and looking at this particular trade idea over here, is we look at the non-commercial positioning. Okay, so what we're looking at is where are the markets actually positioned right now? And looking at this chart, we can see that they're positioned, they are net long at the moment. So it's just at the right-hand side of the chart here, but it's kind of, it's not overly long, so they aren't at extreme levels. And the way that we use this indicator is more for sort of like a contrarian view. So if the markets were at extreme levels, so let's say, for example, we wanted to buy a currency pair and we saw that everybody was long, well, then we may decide that actually it's probably not a great idea to buy that currency pair right now, because if everybody's long, there's no one else there to be able to buy it, to push the markets, even further up. So what we would do is probably just wait for a little bit of a pullback for this to kind of adjust itself from extreme levels, and then look to get long if our view remained the same when the opportunity arose. Okay, but for this idea right here, so where we're looking at the pound dollar, we can see that actually, the net positioning is not at extreme levels. So you could be looking to take a long position or a short position from here. But actually, the way that we're looking at things, and all things considered, we feel that it is kind of mildly bullish for the pound dollar. But there isn't really a clear view on the direction. So what we would be looking to do is really apply our grid framework and look to buy in the bottom parts of the grid. We wouldn't look to sell in the bottom parts, and then get a little bit cautious when we get to the upper parts of the grid. And what I'll do is let me jump over to a chart right now and show you exactly what I mean. Now here you can see the pound dollar, and you can see that we've applied our grid to this chart, and the grid is actually quite simple. All we're doing is we're basing it on previous levels of support and resistance, and then we're looking at the ATR for the daily chart and the distribution between these two levels to make sure that they are roughly about even. And the reason that we want them to be about even is that they kind of play a key role in our overall risk management. Because earlier on I was saying to you that we want to be in a position where even if we don't get the timing right, that we can still make money. And part of that is a way that we're going to utilize our stop losses. And our stop losses actually aren't going to be based on swing points. We're going to take much smaller positions and base our stop losses on the grid. So we'll kind of like have catastrophic stop losses at the bottom of the grid. But whilst we're trading within the grid, we won't really be utilizing stop losses there. I know I know you guys are going to be sat there going, no stop losses. Oh my gosh, how can you possibly make money? You know, it's a recipe for disaster, but I promise you it's absolutely not. The way that we've structured this, you know, and the position sizes that you'll be taking between one level to the next is very, very small. So actually a move all the way from the top here, all the way down to the bottom is going to cost you, you know, roughly about 0.5% of your account. So it's not very, very big at all. And what we'll look to do is to make your money is you'll utilize a portfolio of different trades of different currency pairs as opposed to just focusing on just the one. But I'll do another video where I go more into detail on that later on. Right now I just want to talk about this particular trade idea and just demonstrate how the grid can be quite powerful. And one of the things that I said earlier is that even if you get the direction wrong, you can still make money. And you think, well, how can you do that? Well, let's take a look here. So in the pound dollar, we've actually got this grid already poised for a little bit of a move to the upside, but we're expecting sideways price action. So with this trade idea right here, we're saying that if the market falls into the lower parts of the lower third of this grid, we will look to implement our favorite technical strategy. And we do have a strategy that we'll show you for this, but I don't have enough time in this video here. But at the moment, you can apply your favorite trading strategy to basically buy within this area right here. Then as the market moves up, you would look to take a little bit of profit off the table. If it falls back a bit, you would then look to buy again, and so on and so forth in this grid. So basically, you're looking to buy dips in what we think is going to be a bit of a mild uptrend, and even if it moves sideways, you'll be able to make money. Now, where's the part where even if you got the direction wrong, you'd be able to make money? Well, let's take a look here, okay? And let's add a bottom part to our grid here, and let's assume, okay, so going back to October, November time when the markets clearly turned to the upside, let's assume that you believed that the market was going to go short. So you kind of had a selling bias. Well, utilizing this grid here, what you would do is you wouldn't necessarily look to sell at this sort of area here because you'd want to at least be within the middle third or around the middle third to be able to sell. So you would sell at this position here. And the general movement and volatility of the markets would actually move it in a direction where you could take profit. And then let's say that the market moved back. Well, you took a position at this point over here. Okay. Our stop loss, remember, will be at the top third if we were looking to sell. So somewhere around this area over here. Okay, we would have a very small position in, and what we would do is we would build into our trade. So the market would then move against us a little bit, okay? But we're not worried about it because we've got a very small position on. So a move from here to here is worth all of 0.25%. So it's nothing, right? So a move from there to there is 0.25%. We would then look to get in around this area over here. And then when the market came back to this level, we would be able to close this position that we put on over here for a profit. And we will close this position over here, okay, for break even, which then gives us a net profit on that position. And then we would say, okay, so we'll wait for the market to pull back a little bit again. So the market pulls back here. We would look to sell. The market moves to the next level. So you could look to get out at that level. And these aren't the exact rules, but it's just to give you a bit of an indication as to how you can trade it, okay? So we've got involved in that trade over there. So we've made money here. We've made money here. We're about 0.5% up. Then the market comes back to this level here. We look to sell. Okay, the market goes against us. We would sell again at this level here. Very small positions. Remember, this isn't a martingaling approach. This isn't sort of cost averaging just to save yourself because you've got yourself in a position that you don't want to be in. This is a whole framework to help you manage your risk. Now, when the market comes back to this area here, we would then be able to close that position that we got into over here at a profit, and we could close this position at break even. There again, making a profit. So the market is moving up. We're looking to sell. We've made 0.25%, 0.5%, 0.75% here. The market comes back to this level where it is right now. It moves towards our target area. We don't get our money off the table. It comes back a bit. And at the moment, we're just nursing this one position, which could go either way according to the market dynamics. Okay, so do you see how that is a very, 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 very powerful approach for managing your positions when you're in the markets. We're taking away that need for you to be right on your entries in the markets, okay? And ultimately, if you take away that need to be right on the entry, so you don't need to be right straight away, then you can call the longer term direction using the approach that we're going to teach you over the coming videos, using that particular approach, and you'll be on the right side of the market anyway, making money. So as I said, you get to make money in at least 2 of the 3 market conditions. So if you're with the trend, you make money. If the market's ranging, you make money. And if the market is going against you, actually, you could probably still make money. But even in the worst case scenario, you put yourself in a position where you're not going to lose a great deal of money. Okay, so coming back to our trade idea, the pound dollar, really we've got this grid in here. So the lower part to it is one spot, let's call it one spot 3300. Then we've got another line in at one spot 3490. Another line in at one spot 3663, and then the top part of the grid at the moment is one spot 3856. Okay, so that's the pound dollar idea. Let's go take a look at the next idea. So the other opportunity that we're looking at is one in the New Zealand dollar, and we're actually looking to express this view in the New Zealand yen. And the reason is that last year the New Zealand yen actually traded lower based on safe haven flows and the rate differentials that normally really favor the New Zealand dollar actually coming together. So they converge as the central bank in New Zealand cut rates from 1% down to 0.25%. Okay, and as a result of that, the interest rate differential actually just sits at 0.26%, which is marginally in favor of the New Zealand dollar. Okay, however, these rates actually appear to have come to a halt as New Zealand really kind of continues to manage the pandemic very efficiently and effectively, and the expectations for negative rates have actually completely been priced out, and we kind of view this as a bottom. And in fact, some of the investment bank reports that we read indicate, and one in particular, HSBC, they're kind of saying that there's a potential that the central bank in New Zealand are going to be the first major central bank to hike rates in 2021. So now what we have is we've got the expectation of interest rate differentials kind of driving price. And this is a bit of a different concept, but it is something that we will talk about. So that kind of gives us a bit of a bullish feeling, a bullish bias when we're looking at the New Zealand dollar against the Japanese yen. If you look at the interest rate differentials here, again, just to demonstrate this sort of relationship, as you've got that expectation, you got the interest rate differentials dropping, you can see that the currency rates drop as well. And our job as currency traders is ultimately to try and take a view on which way the interest rate differentials are going to go and trade in that direction. So you see when it drops, the exchange rate drops. When it moves sideways, the exchange rate moves sideways. When it starts to rise, the currency rates rise. When it drops, the exchange rate drops as well. So you can see a very clear relationship there between the interest rate differential and the exchange rate for that pair. And then if we go to look at the non-commercial positioning, okay, we can see that actually they aren't at extreme levels. So again, we're not looking to say we're going to buy based on this or we're going to sell based on this. We just look at this as being sort of like a contrarian indicator so that if we are at extremes, we know not to get involved in that market. But at the moment, we can see that actually it's nowhere near extreme levels. So there's definitely scope to increase here with New Zealand dollar rallies. And that's what we're looking to do in our grid trading approach. Let's go and take a look at the charts. So with the New Zealand yen, we can see that we've got a lower part to the grid. So the support level of the grid, we may as well call that 72.00. And then 73.60 is going to be your first level. Your second resistance level will be 75.22. And then we've got the upper part of this grid at 76.75. Now, looking at the overall outlook, that's not to say that we don't break out to the upside over here. But right now, what we are saying is that if the market is down in this lower third of the grid, then we're going to be looking for opportunities to buy. We'll be looking for opportunities to buy in the middle part of the grid. And as we get towards the top, we're going to be cautious and we're going to have to look at the overall view of the market and the direction of the market and see if there is scope to push out to new highs. Okay, So I hope you all enjoyed that, and I hope that made sense and it kind of wasn't too confusing. I tried to get a lot of information into a short period of a short video there, but I will do other videos where I kind of break down each part of the process and show you, not only how do we look at the grid, but also how do we get that longer term view on the markets, because the approach that we've got and the framework that we put into place really is going to help you make a lot more money trading the FX markets. As I said, even if you're not so great at getting that direction right, but utilizing our process, actually, I don't see how that will be the case, because it kind of is you got these quality gates where you've got to like tick, 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 tick. And by the time you get to actually applying your grid and taking the trade, you've gone through so many different parts of analysis that the direction of the market, as I said, if you get it wrong, you're pretty much unlucky. And even if you do get it wrong, utilizing this approach, you'll be able to make money. So I hope this has been interesting. I hope this has got your mind sort of going. If you've got any questions, please feel free to post it beneath the video here. But as I said, I will do other videos where I break down each part of the process in a little bit more detail to help you there. If you're not already subscribed to the channel, please make sure that you do subscribe to the channel. You absolutely want to do that. I've got some fantastic content coming out this year. So subscribe to the channel, hit the bell so that you get a notification as and when I release a new video. And thank you so much for watching, and I'll see you in the next video. Take care now.